Welcome back to the popular covered call ETF and index comparison series, and to the first one in 2025. If you've been following the series, you'll notice a slightly refreshed look, and that'll hopefully help it stand out a bit more and make it more recognizable. For those viewers who are new, this series is where we compare the most popular monthly dividend paying covered call ETFs in Canada to their peer growth counterparts. These are the safest options out there for those who want passive income while also participating in the growth of the underlying indexes they hold. I personally own many of these, and are all core positions on my portfolio that I'll continue to add to over time. So if you're interested in following how these have performed so far, and over time going forward, feel free to like and subscribe for future videos. We finally passed the 1000 subscriber goal just recently, and I want to just thank everyone for your support and for following along. There's still lots of time left in the year, so let's see if we can get to the goal of 2000 subscribers by the end of 2025. Okay, now let's get into the comparisons. So to start, I'll recap all the details for this series so far, and also introduce a new set of ETFs that will be joining the series starting from 2025. Like many who invest in index ETFs because of their diversification and ease, the same qualities apply here as well. While applying a covered call strategy on top of the indexes might not give you the highest yield, it can provide a steady and reliable distribution every month. And what makes these ideal options for this strategy is because over time the indexes do tend to trend sideways or upwards, and with a more limited degree of volatility. That makes the chances of being capped on the upside potentially fewer than the likes of a single stock ETF using the same strategy. So in general, these are all the comparisons we'll be reviewing within this series. With the S&P 500, it'll be VFV and USCL, and then VSP and HYLD. With the NASDAQ 100, it'll be QQC and QQCL. For the TSX 60, it'll be XIU and CNCL, and then XIU and HDIV. Now as mentioned, there will be some new additions to these comparisons starting for 2025. These ETFs were only launched in the middle of 2024, so it hasn't been a full year yet. But I found these to be quite interesting options when they were first released, so I would like to see how they compare in this context as well. So for the S&P 500, I'll be adding USSL, for the NASDAQ 100, I'll be adding QQQL, and for the TSX 60, I'll be adding CANL. All these are not covered call ETFs and don't provide dividends, but they do apply the use of 25% leverage to each of their underlying indexes in order to enhance the overall performance. I would be interested to see how these would fare against the leveraged covered call options, and if they're able to outperform by the end of the year. Now to explain why these are separated into different groups is because of the currency hedging aspect of the funds being compared. This way their individual performances are not influenced by the currency exchange rates, and allow for a fairer comparison based on the strategies themselves. To briefly touch upon it, if a fund is traded in Canadian dollars but is not currency hedged, this means all the holdings and activities are done in US dollars. So if the Canadian dollar starts to weaken against the US dollar, the overall value of the fund will see an increase in value compared to a fund that is traded in Canadian dollars and is hedging it by converting it back to the Canadian dollar. This can be seen in the example of VFV and VSP, where VFV is unhedged and VSP is hedged. They are both holding the same underlying of the S&P 500, but the difference is the currency hedging. So as you can see in 2024, the Canadian dollar was weakening when compared to the US dollar for the entire year. This is what caused the underperformance in VSP, where a gap is created between the two lines. If you want more details, feel free to watch the previous video after this one to get a better idea. Now these comparisons first started in early 2024 when I had the initial idea, and it naturally made sense to start from the beginning of the year. This is also due to the fact that some of these were only released for less than a year by that point in time. So to have the same starting date for all of them, provide for a fairer comparison rather than starting from each ETF's inception date. Another reason is also because Hamilton ETFs reconstituted and replaced all their previous holdings in HYLD and HDIV with their own lineup of yield maximizer funds. This is why when you're looking at either of these ETFs, you would need to start at this time in order for the performance to be relevant. Then the next detail is that we will be focusing on only enhanced covered call strategies, which means that all these funds use a modest degree of 25% leverage. This is because it helps mitigate some of the upsides that can be capped with the covered call strategy, and to also boost the overall performance of these funds. Now the use of leverage can of course work both ways, where it increases the upside but it can also increase the downside when things take a downturn. But as history shows, the indexes do tend to trend upward over time. So if you're able to endure the short-term volatility, you'll likely be rewarded with greater gains in the long run. Now taking a look at the charts, these comparisons are going to be very straightforward and as simple as possible, and the first one will be purely based on the stock price itself. The second comparison isn't much more complicated, and is just simply adding the dividend distributions that have been paid out to the shareholders back into the fund. This is because when the ETF pays out a dividend distribution, it comes from the fund's earnings being transferred to its shareholders. So by adding back the dividend distribution, it will give a sense of what the total return would look like if those earnings were retained in the fund. Now that should have covered all the details for these comparisons. Next we'll now go look at the charts and see how they all compare to one another. So the spreadsheet now has a few more additions in the form of tabs at the bottom, and that's to allow for two types of comparisons for each index. The current one you see right now is a brand new one, which starts from the beginning of 2025. Then to not lose all the work and have a continuation of the series, I'll also be keeping track of the all-time performances since the start of 2024. This way we get both the current performance and also a broader picture of the long-term performance as well. It's actually getting a little bit out of hand and growing to be a bigger spreadsheet than I had intended it to be. So since we're already here, we'll begin with the all-time comparison from 2024 until today. Starting off with VFV and USCL, you'll see that they all start at 0 and that they are all closely aligned at the beginning in January. This is because the dividend distribution hasn't been paid out yet, which is why once that first distribution is paid, you'll see the lines start to diverge. Again, this doesn't mean it's performing worse, because this is what is paid out to you as a shareholder. Which is why when you're looking at these funds and trying to compare them to the same fund that doesn't pay out a distribution, you have to look at the total returns, which add those back into the price. So over time, on this chart, you can expect it to be a drop or divergence every time on the ex-dividend date when you're comparing it to the index. What is worth noting here is that over the last couple of months, it looks like the difference has remained fairly stable between them. This is a good sign, because it means that USCL has been executing their strategy in a way that it outperforms the distributions they have been paying out every month. So you see later on in the chart below that it's likely they'll outperform VFV once you add back in the distributions for the total return. Switching now to look at the VSP and HYLD comparison, we see something again very similar, where the difference between the lines have also remained fairly stable. Again, it's going to be quite likely HYLD will outperform VSP once you add back in the distributions for total return. So let's scroll down now and see if it's true. Starting with VFV and USCL, you'll now see how the charts are much closer in performance now that the distributions have been added back into the price. And then the section I had mentioned earlier shows here now an outperformance by USCL over this time. So since the start of 2024 until now, USCL has outperformed the underlying index while paying a stable 12 to 13% distribution every month, and has actually even raised that distribution just last month, raising it by 10.87%. This makes sense when you see the outperformance on this chart, and how they've been able to stay ahead consistently over the last few months. Now if we look at it with a different source, we see that without dividends reinvested, it also shows a slight outperformance by about 1%. But if you had reinvested the dividends, the total return would be 3.58% higher than the index. So USCL has definitely been a winner still, and looks to remain as one of my core holdings in the portfolio going forward. Then if we look at VSP and HYLD now, it's shown much of the same where it's outperforming the underlying index. Keep in mind though, HYLD is not a pure index ETF where it holds all 500 companies. Instead, it contains a more concentrated selection of stocks to broadly replicate the index. So I'd say it can be a bit more volatile and depends more greatly on the performance of the selected stocks in the underlying ETFs. But because of this concentration, it looks like it has led to an outperformance of the index for a longer duration of time, starting back from June of 2024. And just like USCL, this has led HYLD to also announce a distribution raise last month, raising it by 1.4%. Looking at it with a different source, without dividends reinvested, it shows the same slight outperformance by HYLD by 0.17%. But if you had reinvested the dividends, the total return will show a higher outperformance by 1.22%. HYLD has been one of the longest held core positions in my portfolio, and will continue to stay for diversification purposes. So overall, it looks like both these covered call ETFs have continued to outperform the underlying indexes. They've also shown that over time, they could also raise their distributions if they are experiencing greater performance. Now let's switch over and see how they're doing so far in 2025. As mentioned for 2025, I've also included USSL to the comparison on these charts. The data from investing.com is a bit spotty on these funds though, most likely because of the liquidity and the volume. So there are some gaps here and there, but we'll see what it looks like over time. If we start with the VFV, USCL, and USSL comparison, they are all fairly close to one another to start. Then on January 31st, which is the ex-dividend date for USCL, is where we start to see the exact point where they diverge, and we see USCL move below the line for VFV. Again, this is normal, because the distribution is being paid out to you, therefore it's taken out of the stock price. USSL on the other hand seems to show some signs of outperformance, but still too early to tell. We'll have to give it some more time. Moving on to the VSP and HYLD comparison, we see it move slightly ahead of the index at the beginning, and even manage to maintain an advantage through the drop on ex-dividend date. But with the recent downturn in the markets, it's now dropped below the index a bit and is negative on the year. So as you can see, this might be due to the concentrated selection, where it can contribute to an outperformance, but also work the other way as well. It's still early though, only being 2 months into the year, and the difference in performance is very slight and could just be temporary. Remember, it's expected on this chart for them to diverge, and keep in mind you would have also been paid out 2 distributions at this point, which will now scroll down to see how it all looks. Beginning with VFV, USCL, and USSL, with the distributions added back in, these are all neck and neck in performance. With it only being 2 months into the year though, you can't really judge performance yet, but currently USCL is ahead by a slight margin. Then USSL on this chart looks to have slipped below the other two and is in third place. Looking at it with a different source, the results are the same where USCL is outperforming without dividends reinvested. With the dividends reinvested, you would still see the same outperformance of about 0.62%. Then for the VSP and HYLD comparison, we see that period of outperformance mentioned earlier, and then just recently it's dropped slightly below the index. Again, it's too early to pass judgment on performance, so we'll just give it some more time. When looking at it with a different source, we see the same results, where HYLD is slightly under the index. Then with dividends reinvested, it's still below by about 0.58%. So overall, I'd say both these covered call ETFs are still doing very well from the all-time return since 2024. Both are currently still ahead of the index, and have maintained some consistency in recent months while increasing their dividends. It's too early to tell so far for 2025, and we'll just have to give it some more time in order to pass better judgment. If we're just going by the performance so far at this moment in time, USCL is out ahead with VFV, and then it looks like VSP, USSL, and HYLD round at the bottom. Now let's switch over to the NASDAQ comparison next, and we'll start again with the all-time return since 2024. Similar to the S&P 500 comparisons, this chart looks as expected and is also showing a similar stability in the difference between the two lines. So as you can expect, when we add the distributions back into the price, we'll likely see an outperformance. So let's scroll down and see. Looking at the chart, it shows a clear outperformance by QQCL and has managed to stay ahead of the index since October of last year. When looking at it on another source, it shows the same outperformance of about 3.16% for QQCL without dividends reinvested. But when looking at it with dividends reinvested, there's an even greater outperformance by 5.96%. So this is a little crazy for a covered call ETF to be beating the underlying index by such a large margin of almost 6%. Even without the dividends reinvested, the difference here is pretty clear who the winner between these two are. And likely because of this, just like the S&P 500 ETFs, QQCL also saw a big increase in distribution of 18%. This is another one that will remain as one of my core positions, and will continue to add to this over time. So let's now move on to the 2025 chart to see what it looks like. Again, we've included QQQL here as a new addition for comparison. Overall, there really isn't much to say so far, aside from the fact that these all remain very close to one another in performance. QQQL is slightly trailing behind the other two, but it's still too early to say. Moving down to the total return chart, there isn't too much to say here as well. The only difference is that QQCL, with the distributions added back into the price, is slightly ahead of the index, but not by much. Then QQQL is the trailer behind both of them. Looking at it from a different source, it confirms the same results, with QQCL being ahead by 0.73% without dividends reinvested. If you reinvest the dividends, you would be up by 0.7%. So in terms of 2025 so far, it's too early to tell at this point in time. We'll just have to wait a while longer and see, but QQCL seems potentially likely to continue its outperformance over the index. And finally, let's get to our last index comparison, the TSX60. Just as a reminder, the comparison between XIU and HDIV is not exactly a fair comparison, because a large portion of HDIV is actually holding US companies. I've gone over the holdings in a previous video, so I'd reference that video after this one if you want more details. So starting with the all-time return since 2024 and the price return chart, it's interesting to see such a clear distinction between the three lines. They've also seemed to find some consistency and have generally maintained the differences between them in the last few months. So let's now scroll down to see the total return chart. Right off the bat, you'll notice that HDIV is a clear-cut runaway winner here, and has stayed ahead of the index for almost the entirety of this chart. And that's why I had to mention ahead of time that this is not exactly a fair comparison, due to the amount of US holdings in the fund. But there isn't another index with a similar mix, so this is sort of the closest comparison. If we then look at the lines for XIU and CNCL, you see that they were fairly close at the beginning of the comparison. But since then, it has underperformed the index, and continues to underperform on a consistent basis to this day. Unfortunately, out of all the comparisons, it looks like CNCL has been and continues to be the only one that has underperformed. If we now look at it with a different source, we see the same result, where without dividend reinvestment, it has CNCL underperforming XIU by about 6.14%. With dividends reinvested, it's underperforming by about 5.22%. Looking at XIU and HDIV now, without dividends reinvested, it has HDIV ahead of the index by approximately 1.54%. Then if you reinvest the dividends, the difference between the two is about 2.76%. So overall, this would be the only comparison where we have the index as the clear winner when it comes to XIU and CNCL. Then between XIU and HDIV, we have HDIV as the winner, but with a caveat that it's not exactly a true and fair comparison. I should also mention that because of this underperformance, while USCL and QQCL saw distribution raises last month, CNCL actually saw a distribution decrease of 10%. And as for HDIV, it saw a small distribution increase of 0.58%. I personally don't own CNCL and have owned HDIV in the past, but no longer own it as well. If I wanted to have more exposure to Canada and had to pick between the two of these, I think it's clear that HDIV would be the clear winner. So let's switch now to the 2025 tab and see how these have fared if we restart from the beginning of this year. Starting with the price return, I would say it's still too early to tell. It does look like CANL might have a slight edge, but we'll have to give it some more time to say for sure. Scrolling down to the total return chart, this makes it even more difficult to tell. So we'll just give this one some more time and see which ones will eventually come out ahead. As you can tell, a lot of time was put into this, so if you could like and subscribe to help out the channel, it would be greatly appreciated. Let me know in the comment section below what your thoughts are, and if you found these comparisons insightful. I'll also include a link to the spreadsheet in the description if you want to take a look at the data and charts for yourself. Thanks for watching, and I'll see you in the next video.